Good morning, everyone. My name is Kerry Craig, and I'm your host this morning. It is Prosperity Indiana's pleasure to have you participate on today's webinar, an introduction to financing affordable housing projects, low-income housing tax credits. We wish to thank today's sponsor, Fifth Third Bank. And before I turn it over to Jacob Brown with Fifth Third Bank, I want to mention a few housekeeping items. Please be aware that all audio is muted. If you would like to ask a question, there are two ways to do so. First, you can use the raised hand icon on your screen, and I will call on you to ask your question. Or you may type your question into the question and answer box, which is also located on your screen. We all know that technology can be trying these days, especially while working from home. So if you lose your connection, you may also reconnect using the link emailed to you. Finally, Prosperity Indiana members may access today's presentation and recording later this afternoon in our member portal. And now I wish to turn it over to Jacob Brown, Vice President and Project Manager Team Lead with Fifth Third Bank for some opening remarks. Jacob?
Morning, thank you. Very humbled and honored to be here again with you as we continue this series. Now more than ever, Fifth Third Bank is proud to remind our communities we have been standing by their side for over 160 years, and that doesn't stop now. Given these unprecedented times, we're communicating more than ever about the resources and information available to secure the financial stability of our clients, our communities, and our families. At Fifth Third, we too are working diligently, much like the rest of you, to remain calm and consistent while trying to manage our organization. Through clear communications and discernment of our current resources, we've mobilized every available asset to better serve our customers while remaining hyper-vigilant to the needs of our own employees. We will continue to be at the forefront of sharing our best practices and expertise throughout these unprecedented times. We're very grateful to Prosperity Indiana for gathering us all together to provide information and resources. We're excited to be a part of this webinar and hear the questions of our region and continue to grow our capacity to serve and advise in the months to come. So thank you again for allowing me to be here with you today.
Thank you, Jacob, and thank you again to our partners at Fifth Third Bank for making today's webinar possible. For more than 30 years, Prosperity Indiana has mobilized members to create economic opportunities and improve social conditions, particularly for Hoosiers who are most disadvantaged. As a statewide cross-sector membership network of approximately 200 organizations and individuals, Prosperity Indiana's impact through members has strengthened communities and improved lives in rural, suburban, and urban areas in every county. It is our mission to build a better future for our communities by providing advocacy, leveraging resources, including providing training and consulting services, and engaging an empowered network of members to do this important work. Our members represent human services, the arts, legal aid, congregations, workforce development, real estate, health services, financial institutions, philanthropy, all levels of government, community action agencies, private and nonprofit affordable housing developers, local economic community development organizations, and much more. If you are not a current member, please go to prosperityindiana.org to learn more. And now it's my pleasure to introduce Peter Nelson. Peter is the Senior Rental Housing Tax Credit Specialist with IHCDA. He has been with IHCDA for over 7 years. Before transitioning to his current role in 2015, Peter spent 2 years as a compliance auditor, monitoring LIHTC project files for program compliance. His current responsibilities include reviewing tax credit applications, providing technical assistance to applicants, and presenting award recommendations to the IHCDA Board of Directors. Peter also serves on the biennial Qualified Allocation Plan Rewrite Team, serving to update IHCDA policy and priorities on how the LIHTC is allocated in the state. Ladies and gentlemen, please welcome Peter Nelson.
Good morning, everyone, and thank you for the introduction. Yes, as mentioned, my name is Peter Nelson. I'm the Senior Rental Housing Tax Credit Specialist at IHCDA. I've been there just over 7 years, and my main function is to serve and work with the Low-Income Housing Tax Credit, also referred to at IHCDA as the Rental Housing Tax Credit. You may have heard it referred to kind of as pronouncing the acronym is LIHTC. So several names, all the same product. So really the first slide here is going to just be kind of the presentation overview, just kind of what am I talking about. Carrie, if you want to advance it one. So really, I'm going to just talk about the basics, just kind of what is the LIHTC, how does it work, how does it function, what does IHCDA do with it? And then I'm going to give an overview of the qualified allocation plan. So that is the document that IHCDA writes. Every state has to write, every housing allocating agency has to write what is called a qualified allocation plan. That's a requirement, one of the very few requirements that the IRS has about the tax credit program, is that the housing allocating agencies write one of these QAPs and have it serve as kind of the guiding document that sets forth our priorities, what we want to see with housing, and how we're going to allocate the credits. I'll go over during that portion kind of IHCDA's set-asides, kind of what we want to see, what we set as our priorities for housing in the state. I'm going to review kind of the threshold requirements. So you're going to come in and do a housing project, you want to receive LIHTC, what's the bare minimum you need to do to be eligible? And then I'm going to go and explain some of our scoring criteria. I'll get to this a little more in depth, but really there's kind of two pools of funding. There's the 9% credit and then the 4% credit, which comes the 4% with a allocation of tax exempt bonds. The 9% credit is very competitive, so scoring really comes into play. We set the threshold. What's the minimum you have to do? Scoring is, what do we want to see? What do we think makes a better project, not only overall, but for the residents who will live there? And how are we going to judge one application over another and determine who gets our funding? So really scoring, that's where that's going to come into play. Although we do have a minimum score for any project to be funded. That's kind of the minimum score is almost a threshold requirement. After that, say your project gets funded, what are some of the basic requirements and next steps that you'll have to follow? Then I'll transition to talk about tax exempt bonds and some of our gap financing. What's the difference between the 9 and the 4% credits, and then what other resources are available. And then I'm going to talk about the next QAP. We're currently under the 2020-2021 QAP. So I'll talk about kind of the next steps and what the next QAP might look like when it will be coming out. And then I'll just kind of give an overview of how and why the tax credit works, and then hopefully have some time for some questions and answers at the end of the presentation. So the next slide gets into the basics. So I kind of already mentioned this, but the IRS is the one who oversees the tax credit program. It was created in 1986 with the new tax bill. It was kind of a counterpart to some tax code that gives some incentive to do single family housing. There also the Congress wanted some incentive for developers to build multifamily rental housing. They didn't just want everything to be home ownership. They wanted, there's a lot of renters in the country, so they wanted to provide some incentive in that tax bill as well. So they created Section 42 of the Internal Revenue Code, and that created the low-income housing tax credit. So just kind of a fun fact, the tax credit is the largest housing program in the country. So the single program, HUD works with a ton of different programs, but if you pinpoint it to a single program, it's actually the tax credit program, which is run through the IRS. So the IRS empowers each state or each housing agency to act as the allocator for the program. The 9% credit that I had mentioned before is based on a per capita basis or a minimum threshold. So some of the really, really small states by population are going to get the bare minimum. So you can see on this slide, Indiana's credit amount is going to be almost 19 million. So it takes the population on that third bullet point of Indiana for 2020, and those numbers are released every year, times the multiplier, which currently is 2.81. So that gives us to almost 19 million. So we'll have that, and we'll be able to allocate that through our 9% round, which is actually currently underway. We received applications the 18th of September. So typical requests that we'll see come in anywhere from about 40 to 50 million in tax credits from applications. So as you can see, even if it's on the low end at 40 million, that's more than double the amount of credits that we have to allocate. So like I mentioned, very, very competitive. And yeah, the last point just mentions, as I already said, the qualified allocation plan, QAP, which I'll probably refer to it most of the rest of the presentation, is our plan for allocating the credits, setting our priorities, and so forth there. So the next slide, just really basically how the tax credit works. So the Department of Treasury is going to issue tax credits to state governments. The state agencies, also known as HFAs, Housing Finance Authorities, are going to write their own qualified allocation plan describing how projects will be selected through the competitive process. Then developers will apply for the credits, and the allocations are going to be awarded to the most qualified applications. In most states, that's simply who scores the highest. After everyone meets the minimum threshold, who scores the highest. Of course, there are some caveats. I'll kind of get into that a little bit later. We have had some, just based on our set-asides, we have had some pretty high scoring applications that don't get funded because they're maybe third or fourth highest scoring in that individual set-aside, and they didn't compete in any others, so they may not get funded. But overall, it's typically you score fairly high, you have a really good chance to get funded. After that, so developers get funds toward construction by selling these credits to investors and syndicators. So typically a bank or an organization who is kind of the intermediary, those are the syndicators, will purchase tax credits. So the example I give here is $750,000 tax credit award. So a developer comes in, applies for tax credits. The amount they can claim is $750,000. Really, that's $750,000 annually for 10 years. So that's a total of $7.5 million worth of tax credits that the investor is going to purchase. Now, at this point, we're seeing different ranges, but investors, let's say, just to make things easy, an investor is going to offer you about 93 cents on the dollar for those tax credits. So that'll translate into about $7 million that the developer will get by selling what is essentially a $7.5 million tax break to a bank. They'll be able to claim those in the $750,000 increments for 10 years going forward, and that'll be a reduction of their tax liability. So with that $7 million, developers will use that for construction to build these projects. Depending on the minimum set-aside that's elected, so there's really 3 minimum set-asides that are set forth. Tax credit properties can only be rented to households whose income is at or below 80% of area median income. That's decided on a county by county basis, and those numbers are released every year. But the highest any tax credit project is going to go is 80% of the income. Now, and then rents will also be restricted in these properties accordingly. And then there's a long-term affordability requirement. There's a compliance period, which is 15 years from the date the property is placed in service. And there's an extended use period. It's a 30-year period, but the first 15 years runs concurrent with the compliance period, and then there's another 15 years beyond that. So really, affordability for these projects is going to be 30 years. The first 15 years, that compliance period is strictly going to be, or not strictly, but it'll be the complete package. Federal IRS requirements are going to be on it. Any state requirement is going to be on it. Now, what happens after that 15 years is the federal restrictions kind of fall off, and there's a lien on the property for the extended use period. So that next 15 years is really just going to be any state requirements that add on. So really, at that point, there's no risk of non-compliance to like lose your credits. So developers, the investors, they're in the clear. Really, the teeth, I guess, to remain affordable through that extended use period is going to be the state being able to say, we'll be able to take points away if you don't remain in compliance on your next applications, or we'll put you on a suspension list until you come back into compliance. So really, that's the teeth there, is the state can levy fines or fees or suspend developers who sometimes rely on these projects to keep their portfolio going. So the next slide is just kind of a review of the timeline for when we get applications and how we allocate our credits. So IHCDA is going to receive what's called a Form C. That's a notice of intent to apply. So anybody who submits an application is going to first submit a Form C. We'll look at those and just get an idea of what's coming in. Those are supposed to be 30 to 60 days before the application is submitted. Then the application submitted, IHCDA will spend time organizing everything, assigning application numbers, getting it into our system for review. And then an individual analyst will review the application for threshold. And then the entire review team will meet and kind of do a group review, making sure we're identifying issues, looking at everything the same, making sure everything's very consistent before we send out our threshold letters. So our threshold letters are going to have any technical deficiency, anything that we need clarification on, and then we'll send those letters out. Applicants are given 2 weeks to respond, and during that time, similar to the threshold, the projects will be scored. The individual analyst will review their set of applications that they have, then they'll do it as a group. Everybody gets together, and we make sure, again, consistency is king there. We want to make sure everything's on the same footing, everything's being looked at the same, all the scores are going to be exactly scored the same way. And then we send those letters out. For scoring, applicants are only given 3 days to respond. Now, there shouldn't be too much. If something wasn't there, applicants can't submit new information beyond after the application due date to be scored. So if something's missing, that's unfortunate, but we can't score it even if it was to be submitted to us later. Really, that's just that 3 days is to give the applicant time to maybe we're looking at it a little bit differently, to just respond and say, hey, I think you missed something or whatever. 3-day response period, and then after that, final scores are determined. We'll review kind of in our funny math how set-asides fit together with the highest scoring applications. And really, we try to get the highest scoring applications funded and then recommend to our board of directors for approval. Now, typically that timeline, applications are due about the end of July, and then we make our recommendations the week before Thanksgiving. That's our normal timeline. Obviously this year, everything's been a little wacky, so applications were due, it got pushed back to mid-September, and we're gonna make our recommendations in February. We hope for next year to get back to our normal timeline. Just quickly while I'm on this slide before, because I don't think I mentioned it, for a bond project, those 4% credits, this timeline is more for the competitive round. The bond timeline really is the same. The only thing is we kind of condense the threshold and scoring. So we send out a single letter and then give 2 weeks to respond. It'll have the threshold and their preliminary score. They'll respond to both. And then since the bond projects, the 4% credits aren't competitive, we'll just make sure they meet minimum score, make sure they're trying to maximize score where they can. And then that process will usually take 3 to 4 months from the time they submit their application until we recommend to our board of directors. All right, so the next slide is just a quick overview of the QAP. I'll just run through housing goals of IHCDA, set aside categories, minimum threshold requirements, and evaluation factors, also known as our scoring. So you can see on the right hand of that slide, just kind of our, actually that might be a little dated, but the just kind of the site in the website where you can view the QAP and all the criteria in there. So the next slide jumps into the housing goals of IHCDA. So for 2020, 2021, the current QAP, our housing goals encourage developments that set aside units at a variety of rent and income levels. So we want to see rent levels set at that 30% AMI as well as the 60% AMI. Anything and everything in between is encouraged. And as well as the rents and the incomes restricted at both would be cool. Just we want to see that. We want to make sure they're part of a comprehensive neighborhood improvement plan with the capability of changing the character of the neighborhood. So we have scoring categories where you can submit if your project is in an area that has a comprehensive plan from the neighborhood, or if there's other off-site improvements that are being done, we have scoring that relates to that. So that's something that we really love to see as part of a project. We want to substantially upgrade and preserve existing affordable housing. New construction's great, preservation of existing housing. I know projects come in, they rehab housing that isn't tax credit, but they come in for the tax credit. So they're preserving housing and adding to the tax credit portfolio. So we know even though the rents may not have changed that much, depending on the market and the housing, that we have that restriction, that rent restriction on it, and it's for 30 years. So we're very excited to upgrade and preserve any housing stock. We also want to connect residents with appropriate services. We found that services really enhance self-sufficiency and quality of life. We have categories determined, set to help provide services to tenants. So that's really a big priority for us. And like I had mentioned with the bond projects, where we like to see, like there's a minimum score, but it's fairly low. We like to see developers maximize their scoring where they can. Services, the tenant improvement plan, with the service requirements, that's one of the areas that we constantly push a little bit to ask if developers can maximize points there. So, and then we like to see developments that are obligated to serve tenant populations with special needs housing. So whether that's persons with disabilities, persons experiencing homelessness, whatever that may be, we like to see at least some units set aside for serving those special needs. All right, so the next slide jumps into our set-aside categories. Now, we currently have 10, so I think we have some of them on this and then some on the following slide, but I'll just run through them quickly here. So for each of these, we have 10% of our credits set aside. So we're going to try to fit as closely as 10% of our allocation into each of these pools, which you'll be able to see kind of why I had mentioned earlier that maybe a development competing only in large city might not be able to be funded if it's very high scoring, but maybe the third or fourth project down in that list if they're not also competing in one of these other set-asides where they might be able to score as well. So having that restriction that we fund 10% in each of these is great, but also if you only compete in one, it may hurt you a little bit when it comes to getting funded. So we have qualified non-for-profit. This is actually a requirement by the IRS that at least 10% of our credits go to qualified non-for-profits. So this just means that the owner of the project is qualified non-for-profit and they have substantial participation, which means they're involved through the entire compliance period, whether that's just has the board of directors oversee ownership or they actively manage the project, whatever that is. Also, any project that competes in this set aside, whether or not they are funded under that set aside, will have to meet the restrictions that are set forth. So they'll have to remain in that substantial participation mode. They need to meet the different requirements that really aren't too extensive, but just a little bit more than normal, just to make sure that even though we're only funding 10% under qualified non-for-profit, really we're going to have anywhere from 20 to 30% every year get funded, just because a lot of these other categories also are competing under different set-asides, one of them being qualified not-for-profit. So if they say they're going to compete there, we're going to hold them to that standard, even if they're funded under another set-aside. Stellar community designation. So host of partners have been doing this for years now. So any community designated a stellar community is eligible for funding in this category. Now, the caveat being their initial stellar community plan that they put forth to kind of apply and then whittle down to finalists, and then finally the 2 stellar communities every year. Their initial plan that they put out has to have a specific tax credit project identified in that to qualify for that funding. Community integration, this was a fairly new category, if not for this 2020, for the 18-19 QAP, but 20 to 25% of the total development units need to have at least one member with an intellectual or developmental disability. So that was a need that was clearly missing, and so we tried to make that one of our set-asides to really draw people into creating some more housing for that population. Development location, so really, if you don't hit some of these other set-asides, you're going to at least hit one of these development location set-asides. We divide it up between large city, small city, and rural. You can see the numbers breakdown of what we classify as that. Really, each of those is about a third of the state, give or take. So, and we set aside 10% of the credits in each of those. So 30 overall goes to development location. The next slide continues set-aside categories. Preservation, anything that already has a federally assisted affordable housing restriction on it. So whether that's HUD funding or a tax credit project outside of its 15 years wants to come back in for additional tax credits, we'll qualify those as preservation. We also have workforce housing. We've been trying to, we hear workforce housing is a big need in the state. So we tried to determine the best way to do this with the tax credit program. So they need to be located in counties that rank in the top 10 in the state for economic well-being and employment and productivity. I don't have like the outline of how we determined all that in front of me, but it kind of whittled it down to 10 states. I know we've since whittled that down to a couple fewer counties, just because some of those counties had a project or two that qualified for workforce housing. So we didn't want to oversaturate any area and wanted to make sure we could kind of spread those out. Actually, it looks like I forgot to update this slide. They cannot be age restricted. That still remains, but where it says it's comprised solely of units with 60% AMI, that is no longer accurate. So the change there from when this slide was initially created to this QAP, the 2020, the one we're under, the projects must be income averaging. So that's the minimum set aside that they have to elect. So that means they can get anybody up to 80% of AMI rents. So that is a little bit different. So I apologize for that oversight there. We also have the Housing First. Those units really target the homeless population. So we set aside 10% of our credits for, we have what's called the Indiana Supportive Housing Institute. So you have to commit 100% of the units in these projects, go through the institute, and commit to the Housing First model of permanent supportive housing. So they'll go through the institute, they'll have a whole plan laid out. It'll be great, and then they qualify, and they're good. The general set aside, this is typically actually outside of our normal competitive round. So it's a special focus announced each year by the executive director. And in previous years, what we've done is called like the moving forward. We want to make sure that transportation and housing and utilities, all of that combined is kind of the tenant won't have to pay more than like 30% of their income. So that's been the overall goal. We've worked in some green requirements for that, hoping to reduce utility bills. But we've tried different things, and we have different things for the general round. Normally, to compete in that round, developers will come in, they'll present like kind of their basic overview of a project, what their idea is, but really we're looking at a development team, like a comprehensive team for this. And then we'll elect a couple of teams every year, and then they'll go through the normal process in kind of a separate general round. Actually, for this upcoming round, the 2021 round, we're just wrapping the general credits into the rest of our 9%. So no real special initiative this year. We just realized with COVID happening, we need to get as many projects out and open and going as quickly as possible. So wrapping these general credits into our normal round seemed like the best move to go from there. Excuse me. So the next slide shows our minimum threshold requirements. So as I said earlier, this is the bare minimum that any project needs to do in order to be considered for funding. So we're going to look at development feasibility. Every development is required to submit a market study. Is there a market for these projects? Is there a market for the number of 3 bedrooms that you are planning to have in your project? How does it compare to other tax credit projects in the area? How quickly will it lease up? All of that stuff we look at, and we make sure that the project in that location is going to be feasible. We also look at financial capabilities and managerial capabilities of the development team. So do you have experience in tax credits? Are you going to be at capacity? Do you have too many projects going? Are you able to fund this financially? Does the management team have experience? We also need site control when you apply. So do you own the land or have a purchase agreement in place by the time you're applying for credits? Evidence of financing, you'll have need to talk to a bank or a syndicator, whoever. You need to show that somebody's willing to buy the credits and provide any other loans or gap financing that you need, whether that gap is coming from the city or another source. But just you have all the financing in place, perfectly fine if it's contingent upon a tax credit award. But you need to have that in place before we can move forward to show that you can build that project, that you'll have the financing to build that project. The evidence of compliance, that's just, do you have any current tax credit projects? Are any out of compliance at this point? We have affidavits that you plan to stay in compliance, et cetera. So we'll look at that. Zoning, we want to make sure the project's zoned appropriately. If it's not, get it rezoned. We also do an environmental assessment. Well, we don't do it. You have a phase one, an environmental phase one, and submit it to us. So that'll look, we want to make sure there's not a floodplain around, and just if there are any environmentally recognized conditions, that those are addressed, and that your budget will kind of reflect any work that would need to be done relating to that. We'll review underwriting guidelines. We have a minimum DCR that'll need to be maintained, a debt coverage ratio. So a vacancy rate, we'll need to see that within a certain range. We have a number of operating reserves that you're going to have to hit. Different things related to underwriting that we see are reasonable. You'll need to be in the range for those. And if you're not in the range for those, you'll need to provide a very good explanation as to why. Probably show some historic data that you have for your projects that show why your projects are outside of those guidelines or whatever. But general guidelines remain within our guidelines. We also have fee limitations, so you can't take a developer fee that's just insanely high. It's usually based on the number of units that you have online. The fee limitations are that. And then we have minimum development standards. How are you building the project? What materials are you using, etc. So the next slide gets into our scoring. So once everything meets threshold, we look at scoring. We want to see the rents charged is a big scoring category. Do you have that mix that we talked about? Do you have, so I'll just throw out the way to maximize your scoring points in rents charged is you have 25% of your units at that lowest 30% AMI. So the rents that you're charging are going to be at the 30% of the area median income. You'll need at least another 25% at or below 50% AMI. So 50% total units at or below 50% with 25% at or below that 30% AMI. And then the rest of the units you can do with as you please. Typically, most people max them out at the 60% AMI. If they're doing the income averaging, they'll do a mix of the 80 and 60%. And you don't see a lot of market rate units in with our competitive 9% credits. Typically, those are 100% affordable, but it happens. You'll see that more with the bond projects where you'll see some market rate units mixed in, but that can be factored in that other 50%. So that'll maximize points there. We also look at development characteristics. What kind of amenities are you putting in? We usually have a list of different amenities that we want to see. You can select from a handful of those, similar to universal design features. Are you including, I don't know, like simple things like USB ports with your wall outlets, or do you have a carport or a closed garage for your parking, or just different things regarding universal design. We'll have some that applies to the project overall, where you'll need to pick a certain number. We'll have some to the interior of the unit where you'll have to pick some, and then that we have unit size scoring categories. So do you exceed unit size in all your units? We have different, so vacant structure, historic in nature, preservation, and kind of infill. Those are kind of our categories for just kind of what type of project you're doing. So if you have a vacant structure, it needs to be 100% vacant. How much of that structure are you using? depends how many points you're going to get. If you're doing rehab on a historic building, you can qualify for points. If you're preserving affordable housing, you can get points. Infill. So with new construction, we really want to make sure that you are doing an infill project. So is there other housing around it? We don't want you to just stick, affordable housing project in the middle of a cornfield somewhere. We want to make sure amenities are around, so we incentivize infill with these points. We also see that you promote neighborhood stabilization, whether that's using different funding sources or have like an improvement plan, which is mentioned below. We want to see different things. Previously, IHCDA had like a blight elimination program where we tear down blighted houses using funding. So if your project was built on one of those sites, you could qualify for points in the neighborhood stabilization. I had mentioned a little bit earlier offsite improvements. And then we have kind of a cost containment category. How many tax credits are you claiming per unit and then per bedroom? So we want to make sure our credits can go as far as they can produce as many units and bedrooms as possible to get more people housed. So we have a little bit of a cost containment measure that qualifies for points in that. Continuing evaluation factors. This next slide is a little small type. I hopefully can go over it fairly quickly, but sustainable characteristics. Are you meeting some building certifications, water conservation, etc.? We also have desirable sites. We want to see, are there amenities around it? Is it easily accessed to transit? Like, is there a bus stop? Or in certain areas, we can do like point-to-point transit. In more rural areas, we don't expect like a bus stop or a bus service to be in those areas, but is there a point-to-point that can take residents from the site to, a doctor's office or whatever they may need? We also score for financing and market. Are you leveraging other funding sources to come in, or is it just IHCDA funding? We give points for rental assistance. So if you can bring in other sources of rental assistance, that's great. We like to see that. So census tracts without active tax credit properties, we like to spread it around, make sure every area that needs affordable housing can get one. So we kind of incentivize going into a new area a little bit. That's not to say Indianapolis, who has multiple tax credit projects every year, can't get funded without those points, but it helps other communities who may not have as many as far as like amenities and different things that Indianapolis would have also be able to get that little bit of boost, since they also need affordable housing to be able to score well. And then we have housing needs index. It just hits a couple areas like, is there like how many renters are in your county, how many affordable housing units are in your county, and just kind of weighs those to kind of try to show the need for housing. So counties with more need score a little bit of point based on those criteria. And then we have some other categories. Is your management company certified tax credit specialist? Are you integrating minority-owned businesses, women-owned businesses into your development team? Tenant investment plan, which I had mentioned earlier, and then some other things: smoke-free housing, supportive housing models, etc. Okay, so that was a lot, but then you get through all those steps. You meet threshold, you score well, you get funded. What happens next? So IHCDA is going to make our award. Owners are going to sign what's called a carryover agreement. So the tax credit rule says you have to be placed in service the year you're awarded credits, or you can sign what's called a carryover agreement, which allows you to carry those credits over into the next year. Really, we've seen that putting a project into service that year that you're awarded is very unrealistic, so everybody signs a carryover agreement. Now, those are only applicable to the 9% deals. The 4% credits don't have the same restrictions. Those can be carried on and on. Because really it's not a per capita thing. I'll get into that a little bit. Then development begins to work on closing all their financing, finalize their construction schedule. They'll provide regular updates to IHCDA on how that works. And then the development must be placed in service by the end of the second calendar year after the allocation. Once that's placed in service, 15-year compliance period starts. Jump to the next slide where I can get to tax-exempt bonds. I'll just briefly go over the differences between the 9% and the 4%. Bonds are an open round. We don't allocate bonds without an allocation of the 4% credit. 4% credits are not based on a per capita. We do have a bond volume amount that we can exceed. So once we hit that, we can't allocate any more 4% credits. So just kind of some of the differences with threshold, they may exceed the credit cap because really there's not a per capita credit. So they can go as high as they need to as long as they have sufficient eligible basis. So eligible costs, they can hit that, or they can exceed that cap. Developer fee is calculated differently. You can take 15% of your eligible basis and can defer a higher amount up to 80% instead of 60. Again, another slide I missed, but there is now a minimum score for bond deals, but it is 40 instead of 80. The credit rate is floating. It's not fixed at 9%. It's not fixed at 4%. It's floating. Currently, it's like I can't remember what it is, but it's low. It's 3.1 something, I think, at this point, but it's pretty low. Also, IHCDA can give a discretionary boost to 9% credit that allows you to multiply your allocation, your credit amount, multiply your eligible basis to increase your credit amount. But unfortunately, only a qualified census tract can get that boost for bond deals right now. And then I kind of mentioned this already, but 90 to 120 days from submission to recommendation for these applications. And the closing deadline is 5 months later, and there's no carryover agreement, which I said. So the next slide shows our gap financing options. I'm trying to speed through this a little bit. I'm sorry, but want to be able to answer some questions if there are any. IHCDA has what's called a development fund. It's up to a $500,000 loan, 3% interest, 30-year AM, 15-year term. The only restriction on this is you must set aside some units at or below 50% AMI. So even if you're doing all 60s, you have to set at least probably about 10% of your units. There's a calculation that we follow, but about 10% of your units are going to have to be at 50% AMI. We also have home funding. They're only available to non-for-profit entities, and we typically don't see them allocated toward bond projects. The thing with home is there are certain PJs, participating jurisdictions. So like the city of Indianapolis, IHCDA couldn't give home funding to a project in Indy. The city would have to award home funding to that developer. So they'll have their own process on how they award that. And then the next slide goes through the timeline. We are currently writing the next draft of the QAP. We expect a first draft to be released hopefully in January. We'll have a 2-week public comment period, and then we'll release a second draft hopefully in February, have another 2-week comment period, put the final tweaks on it based on all the comments, and then hopefully by March we'll present the final draft, final version to our board of directors. They'll vote to give us approval to submit it to the governor for final approval. One of the IRS requirements is that the governor of the state has to sign the QAP. So we expect, based on this timeline, late March, early April, mid-April maybe, that the governor will have signed it and will release the 2022-2023 QAP, and then get back to our July timeline for application due dates for the next round of applications. We would release what's called red notices for finalizing these dates and times, and also anything else related to our real estate team, but should be good there. Just kind of to sum up, the next slide, last slide, how it works. So really, this tax credit is a public-private partnership with investors assuming risk. It's not just, us giving a pot of money to somebody and saying build housing. It has administration and decision-making authority delegated to state government. So the QAP, my team, writes this every 2 years. We change our priorities based on what we're seeing, based on what we see works, what we need in the state as far as housing needs that are unmet, and we try to tweak it every year to meet those requirements. You can see it's a big contributor to the economy. Every year, $3.5 billion in federal, state, and local taxes are generated from this program, and $9.1 billion in economic income from wages and businesses. Also, just shy of 100,000 jobs in various industries are affected because of this program. You can see very, very few have undergone foreclosure. It's a very successful program. And then it meets needs that otherwise couldn't be addressed by the private sector. So it's able to reach the lowest income population. Otherwise, a lot of the rents wouldn't support the costs for these projects. So having that tax credit lets us target those extremely low income and make these projects work. So that's it. I kind of have a thank you slide and am able to take any questions at this point. I'll let Carrie kind of run the show, and if there are any questions, I'm happy to answer them right now. Hopefully I left enough time for any of those that may be out there.
Well, thank you, Peter. And I would just like to remind participants that if you'd like to ask a question of Peter, you could do so two ways. You can type your question in the question box and I will read it out loud, or you can use the raised hand icon and I will call on you and you can ask your question directly. I know that Peter covered a lot of information, so surely we have some questions. Give folks a few minutes or moments. Okay, we have a question here from Molly Trueblood. She says, first of all, excellent presentation. Is there a place where we can find out where previously awarded projects are located?
Yeah, that is a good question. So on our website, so in.gov/IHCDA, we have several things. You'll see some really big square icons on that site. If you click on developers, that'll take you kind of to our development page. And then from there, it'll scroll down, kind of list all of our development programs. There's one listed as rental housing tax credits, RHTC. So go there. That's kind of a lot to remember, but if you go, you should be able to find it. It's, I think, mostly user-friendly. So once you're on our rental housing tax credit page, you'll be able to scroll down. We have a section called awards and applications and awards, something like that, where it lists all of our existing properties. I think some of them you can pull by year, whether I know we archive some stuff when we kind of switch to a little more user-friendly website, but it'll have previous allocations, previous applicants even. We released a list, actually, I think late last week of all the applicants for the current 9% round. So you'll be able to see that information as well. And we also have what's called an existing rental housing tax credit properties report that we pull every so often. And that'll show you every project in our portfolio. It'll be downloaded in like an Excel version. You can pull it, organize it by county or city or however you want to do it, and find properties that way as well.
Great, thank you, Peter. A second question from Lisa Laughlin. She asked, are we able to do special set-aside categories on different floors of a multi-floor building? For example, workforce on one floor, supportive on another, etc.?
The set-asides are going to have to apply to the entire project. So I kind of explained how to get to the existing properties, but also our QAP is located on that rental housing tax credits webpage. So if you go in and kind of read a little more in depth, it'll show you all the requirements, but it's going to have to be pretty much an entire project. I think some of them depending on, every once in a while we'll get like a scattered site project, but like for preservation, for example, at least half of the units are going to have to be preserved. So we know, like, sometimes housing's tore down and then rebuilt, but it'll still maintain the same funding from HUD. So we'll qualify that as preservation as long as half the units are rebuilt. So unfortunately, the answer to your question, the short answer is no. You can't really set aside different floors for the different set asides. They're more whole project qualifications.
Any other questions for Peter? Again, you can use the raised hand icon, or you can type your question directly into the question box. Well, seeing no more questions, on behalf of Prosperity Indiana, I want to thank each of you for participating in today's webinar, An Introduction to Financing Affordable Housing Projects. Please look for an email from me this afternoon inviting you to take a very brief survey. Your feedback is important as we use this information to enhance the quality of our webinars and training. Also, please check out our website, prosperityindiana.org, to view upcoming events and training in August. Next Tuesday, October 13th, we will host a webinar, Topics in Affordable Housing. The webinar will cover affordable housing data in Indiana, a look at renter protections, and understanding housing discrimination. The webinar begins at 10 a.m. Eastern Time, and registration is open on our website. Before we close, I'd like to thank today's sponsor, Fifth Third Bank, for their support in helping us to host these informative webinars. I also wish to thank our presenter, Peter Nelson, for sharing his insights. Again, we appreciate your participation. This now concludes our webinar. Thank you, everyone, and have a wonderful week.